Good afternoon, everybody. My name is Katie Ensweiler. I'm the marketing manager here at VonLehman CPA Advisory Firm. A few housekeeping items before we get started. This session is being recorded, so in case you miss anything, please feel free to review the link I will be sending out later on today or tomorrow. I will also be sending out the contact information for all of our panelists today. So if you do have a question that we are unable to get to today, please feel free to reach out to any of them. If you do have any questions, please submit them in the chat feature on Zoom. Again, we'll do the very best we can to get to everybody's questions, but you will be provided with the link and the contact information for all of our panelists. For those that do stay on today's webinar for at least 50 minutes, you will be awarded a CPE certificate. We'll be sending those out in the coming days, so please check your inbox for that. A huge thank you to HORAN and Graydon for partnering on this event. They've been tremendous partners over the past few years, and we look forward to a great future with them continued. With that, I will go ahead and turn it over to Paul Carl with HORAN, who will be our moderator for today's presentation.
Hey, good afternoon, everyone. Thank you for joining us. We're thrilled that everyone's here. We've got an all-star lineup to as panelists, including rock star Laura Murrer, Kerri Walz, and John Kirk. So we're going to each introduce ourselves, and I'll go first. So for nearly 75 years, HORAN has served as an independent and trusted advisor for retirement plan consulting, health benefits, wealth management, and life insurance solutions. Today, more than 500 companies partner with HORAN to guide their organization's health and welfare benefit strategies. I'm a vice president at HORAN. I leverage my unique experience as a former Department of Labor senior investigator to design and manage plans and to help employers mitigate risk and employees retire successfully. Laura, I'll turn it over to you if you want to introduce yourself.
Paul, that's a hard act to follow. I'm a CPA, started my career in public accounting, but I'm the daughter, granddaughter, and great-granddaughter of small business owners. So I saw a niche for a company that would target small and medium-sized firms and help them with their retirement plan. So I founded a company that does that. We continue to do that, a part of Latitude Retirement Services now. We help, again, small and medium-sized companies design, implement, and we provide administration services ongoing for them.
Great, thank you. And Kerri?
Yeah, I'm Kerri Walz. I'm a manager at VonLehman. I joined VonLehman in 2013 as part of the acquisition of Dunbar Cook & Shepherd, which I joined in 1998. I specialize in employee benefit plan auditing and audit and accounting services for small to medium-sized, closely held businesses.
Fantastic. And last but not least, John, congratulations on your new partnership at Graydon. If you'd like to introduce yourself.
Well, thank you. And Graydon has HORAN beat. We are 150 years old, providing legal advice to the Cincinnati and Northern Kentucky area. I've been practicing about 20 years. Like Paul, I was an investigator at the Department of Labor many moons ago, investigating benefit issues. I head the benefits practice at Graydon. I'm the chair of the group, and we deal with all, retirement plans, executive comp, health and welfare, sort of like Paul and everybody else. If you have a health plan or a plan or something you offer your employees, we provide legal advice for it.
Fantastic. Thank you, John. So we're going to jump into some questions. And if anyone in the audience has any questions that they'd like to ask the panelists, please do so through the chat function. Laura, we are going to start with you. It is the busiest time of the year for third-party administrators. This would include, of course, you and your staff at Latitude. What can the employer do to help facilitate the processing of year-end information for the compliance testing?
Paul, it's a great question. And we appreciate that our clients are very busy now too. We're in peak season, like all of my colleagues in the accounting profession, but we also understand that HR and the accounting departments of our clients are really busy now too. We request a lot of information from you. We recommend that you allocate the proper personnel and time to do it properly. Some of the big issues that we have is please provide complete information. Advise us of all employees. You know, if certain categories of employees are excluded, we still need to know about them. They may otherwise be eligible, but for their exclusion, they would factor into compliance testing. Be sure to give us dates of birth. If they've terminated, please fill in dates of termination. Our biggest issue, and I know Kerri will agree with me on this, but we'll see if she does later on. Compensation. Please know your plan's definition of compensation. They can vary, and make certain that you report that compensation to us. I'm going to sound like a real accountant here, but pull out your year-to-date payroll register. Tie your totals back to it. If your definition of compensation is W-2 wages, have you included taxable group life insurance, group term life insurance? Do you have taxable fringes? Be certain that you include all of that compensation in. And it's another issue that we do look for too is severance pay. We do ask that you identify severance pay. If someone's terminated, but you continue to pay them for many months thereafter, that's not necessarily eligible pay. And you need to identify it. And we're going to pick up on that. If their termination date's in a prior year, we're going to say, whoa, did you rehire them? But if they terminated sometime during the year, we might not pick up on that. So you do need to address that. Terminations. If you've had a high turnover this year, we may come back to you and ask who's involuntarily terminated and who's voluntarily. There's a turnover ratio we have to run, and we're looking for partial plan termination issues. So I know it's a lot of information that we ask for, but there's really a reason why we ask for it. And for those of you that are going to undergo an independent audit from firms like VonLehman, they're going to be asking these same questions. So let's get ahead of them on this. Let's get ready for this audit and get good data in order for them.
Beat them to the punch, so
Yes.
to speak. So, Laura, I'm going to continue with you. And you know, you said this. Not only is it a busy time for TPAs, but the employers, I mean, especially the accounting and human resource staffs, are extremely busy as well. Just normally, forget about the whole, you know, trying to find employee talent and so forth. Just normal year, they're extremely busy. So included in the package that you send to clients, there's usually a lengthy questionnaire. And the question is really, how important are all the questions on this questionnaire? And do they need to be answered by a certain date or deadline?
Well, the questionnaire is very important. And the purpose of it is that we're trying to have your back, and we're trying to troubleshoot issues and make you think about certain things. So it's really important to complete that questionnaire, and we cannot complete our work till it's done. Some of the questions, and I know I get a lot of questions from clients on this, and this is something that a lot of the questions may not apply or they don't understand it, but we're asking things that are kind of confidential sometimes. You know, people say, well, why do you need details on ownership and officer status and who's related to who? Well, that's for compliance testing. We'll ask, are you part of a control group? Did you acquire any companies? Did you sell any companies? Did you terminate services at any location? We're looking for partial plan terminations. We do the document work for many of our clients, but many of our clients also engage ERISA counsel to do their plan documents. Did you amend the plan during the year? We're in the middle of a cycle 3 restatement period. Many of you may have already done your cycle 3 restatement. We've still got a little time till July, but make certain that all of your service providers have any amendments or restatements. So I know I get, and if you don't know how to answer the questions, call your service provider and have them walk you through it. We're happy to do it. Don't spin your wheels for an hour and get frustrated and then be all mad at me for asking these questions. Our purpose is really to troubleshoot issues ahead of time and help you think about some things.
So Laura, if nothing, I'm sorry, John. I was just going to ask real quick. If nothing's changed year over year, is the response, everything's the same as last year? Use last year's response, okay?
We have accepted that, Paul, but I would prefer that it's answered, but we have accepted that, that nothing has changed. But really, I do encourage employers, there's a lot going on in the last year or two. And we very much appreciate how busy and stressed everyone is. But spending a little time up front can maybe prevent some problems down the road.
Okay.
So a little preventative medicine perhaps is in order here.
Okay. So John, did you have a question for Laura?
No, Paul, I was gonna say, you asked the question, I was gonna ask us, routinely, we get the, hey, nothing's changed. In big picture, it hasn't, except, you terminated 75 people over the course of the year, and nothing really changed. We didn't buy anybody, sell anybody, but we did have that partial plan termination.
That's right. That's right.
I don't back Laura up. If you don't want to call Laura, call your benefits attorney. We can help you with those questions as well. But one of the biggest things we see, to Laura's point, is compensation. Whether we helped you with your plan documents, Laura's team did your plan documents, a Fidelity, whoever did your plan documents, make sure what you think is compensation in the plan and what you're actually doing for compensation for deferrals and all those sorts of things match. So, especially if you have some new HR people or new payroll people, make sure they actually pull the plan document and amendments and look and say, here's what counts for comp and here's what doesn't. Because routinely we end up in an audit, we get the phone call after the audit or in the middle of the audit and say, hey, we've got an issue. It's 9 times out of 10, it's either we failed testing or it's comp.
If I could piggyback on that too, Paul, sometimes we'll notice that we get all these really odd deferral rates. Somebody's at 3.872%, but they match up to 4. And then we kind of dig a little deeper and we find out, oh, they didn't withhold from bonus pay. Or, or the payroll service just kind of forgot about overtime and didn't withhold. So troubleshooting those issues up front, because Kerri's going to catch that on the audit.
Yeah.
If you've got a missed deferral opportunity, there are self-correction procedures you can take to fix these problems. The very best employer can make a mistake. Don't beat yourself up, just fix it.
Yeah. Good advice. Better to come forward with something and acknowledge and correct it the right way, and more or less take care of it and keep the government from digging too deeply, so to speak. So, hey, John, so several of the questions that are on the questionnaire that the TPAs need to ask for compliance testing really involve the employer's merger and acquisition activities during the year. There can also be some personal questions, what I consider to be personal questions, that delve into the owner's other businesses. Why are these M&A and controlling interest questions really that important, and how accurate do the responses need to be?
Well, I would say we need the responses to be absolutely accurate, because when Kerri runs her testing, as part of that audit, they're looking for, are there any other plans that we need to include in this test, or are there any other employees we need to include in this test? Because maybe you, owner, you own 100% of this, I will say, car wash. And it's got 50 or so employees, but you and your brother, but you own 80% of this other, manufacturing company. Well, now we're running into control group issues where maybe we should have offered the car wash employees to be in one of the plans or cover them under other plan, or maybe we have to now include them in testing. So yeah, those questions do get a little personal, but it's because the IRS really, really cares about your personal details of what you own and what you've bought during the year, because as soon as you acquire something or divest of something, it potentially changes who's eligible under your plans or who needs to be included in all those tests they run.
So John, along those lines, if an employer acquires someone during the year, and let's say that let's say nothing was done to address the employer's retirement plan, that what am I trying to say? The acquiree's retirement plan. Does that plan need to be merged into the acquirer's plan by the end of the year? What's the timing on that, and how important is that information?
Yeah, it doesn't have to be merged. I mean, you never have to merge plans. Sometimes it makes a lot of sense, and sometimes it makes absolutely zero sense to do a planned merger. But if buyer buys the assets of a company, well, maybe they didn't even take the plan over, and maybe that's the seller needs to finish whatever they had. If we bought the stock of the company, now buyer, that's now the buyer's plan. They own that plan. And so they need to make that decision early on. Are we going to merge it, or are we going to continue on its own, or are we going to freeze it, or are we going to do multiple options to it? But it's very important to, whatever you do it generally within the same plan year, because as soon as we start crossing tax years, we run into a whole host of problems with the Department of Labor and with the IRS and with audits and with 5500s and all those sorts of things. So if it's toward the end of the year, a lot of times they might just sort of let it ride and it's do it. But if you buy something this time, first quarter, second quarter, you have a fairly lengthy runway to make sure you've taken care of that plan and gotten rid of it or merged or whatever you want to do. I'm working with a client right now where they bought a plan in 2019. I bought a company and they had a plan, and they thought they had done the final 5500, but realized they'd never actually filed it. It just sort of slipped through the cracks as all the other mergers, were integrating employees and payroll and all. And here's this one 5500. And so now we're going through voluntary correction to fix it. Again, to Laura's point, there are many voluntary correction plans and procedures and programs out there from the various governmental entities at relatively low cost compared to what they could charge you on the per day fees being late. But that should be on your list anytime you have an acquisition or a sale of payroll, financial audit. What are we doing with the plans? Who's in charge of doing whatever it is that we need to do with the plans?
Gotcha. Very good. Thank you. So, Kerri, we've mentioned compliance testing a few times. We've mentioned payroll challenges and so forth. What during a plan audit, what are the errors that typically relate to compliance testing that you see?
So the first thing that we do, like Laura said, is we'll take the census that we get from the plan sponsor. We're going to tie that back to payroll and make sure we have a complete census. Then we're going to take that census and we're going to reconcile to the compliance testing to make sure they didn't exclude a group of people, or, if they excluded them, then we're going to send it right back and say, you need to get with your TPA and have compliance testing redone because, it wasn't accurately completed. So that's the first thing that we do. A lot of times we might see that the compliance testing wasn't done by the 3/15 deadline. I mean, it doesn't happen very often, but occasionally we'll see that. And then sometimes maybe the corrections weren't made in a timely manner. In both of those cases, we would issue a management recommendation that they get with their third-party administrator or their risk attorney and make sure that they get those corrections done in a timely fashion. And then they may have to pay an excise tax for that. But what Laura was saying about compensation, we do a test, and it always pops out in this test that we do, whether they're using the correct definition of compensation. And like you said, then if the percentages are off or something's not coming out right, we know that some compensation was excluded. And we look at the plan document and we make sure that the definition in there agrees to what the plan sponsor is using. That's one of our tests that we do.
So I guess this question's really for anybody that wants to grab it. And is there a cheat sheet or a shortcut to compensation definitions that an employer could reference or go to? Has anybody seen anything like that?
I actually have, Paul, there, but it goes between 415, W2, 3401A, different definitions of compensation, what's in and what's not in. I'll tell you the biggest challenge we have and our clients do, some of them have so many different categories of compensation. and different taxable fringes. And you can't always tell by looking at the payroll register because they don't always title them right. No disrespect meant, but it's extremely challenging sometimes to determine the proper compensation. And that's something they really need to address long before year end, because they want to set it up in payroll properly to be withholding from the proper comp. And if it's not a cash item, and I know John would put this in his documents, but non-cash taxable compensation, you can't really withhold from. So you're going to have language in your document to give you a little leeway on that, but it still might be relevant for calculating any match or profit sharing contribution or compliance testing. It's the most challenging thing, and it should be simpler. And there should be a de minimis on that. You know, if somebody's off just a little bit, I mean, it's a real challenge for employers. And I'm not unsympathetic at all to some of these complex payrolls.
And so, Laura, you mentioned de minimis. Kerri, you know, from an auditor's perspective, is there a de minimis that can be applied here, or, you know, do employers need to pretty much adhere to the exact?
Well, we will run the test. We'll see if they, you know, if it's off, and we're going to issue a management recommendation if it's off. We try to get it within $1. I mean, that's kind of our limit is $1. And usually, you know, like I said, when we run this test, the errors come out. If there's a problem, it pops out when we're running this. So we would issue a management recommendation if they're, like you said, not deferring on bonuses. We see that that's probably our number one error that we see, is they're not deferring on bonuses. And so we would issue a management recommendation that they get those corrected. So usually it's $1 that we try to reconcile to.
Okay. So John, you know, maybe some employers don't want to defer on bonus. Can those be excluded for deferral purposes in a plan document?
They can be. I mean, again, it goes back to your definition of compensation in your plan document. So we have a lot of clients that, you know, they just say, we universally, you know, anything we pay you, we're going to withhold or defer from, including bonuses, because it's all, we all consider it all comp. We have some clients that do a blanket. We don't do any deferrals from bonus because we're not really sure what those are going to be year to year, if anything. So we just exclude bonuses. And then we have a third category of clients that say we will in general not defer from bonuses, but here is a special deferral sheet you can fill out if you would like to have some amount deferred from your bonus. And so to answer your question, no, you don't have to, but you know, a lot of people, especially I think it depends on how big your bonus is going to be. You know, if it's a fairly small bonus, most employees probably wouldn't want to. But if it's a larger bonus, you know, potentially 5 figures, those sorts of things, you may want to, because it's a nice chunk of change to, you know, put into your account, especially if you're not at the limits. Or maybe you're using your bonus to get to your max deferral rate limit.
And Paul, I wanted to add, so when we do these calculations, we do always ask the plan sponsor, do you have a form from these employees where the bonus, you know, they didn't defer on it? Do you have an election out form? And if they have that, that's perfectly fine. You know, we accept that, but we look at the plan document. If it's supposed to include the bonuses as part of compensation, then that's what we need to use, unless they have an election out form. So.
Right. So
yeah, where I see problems pop up sometimes is where they've grown to the size of, you know, now we're getting audits and all those sorts of things, and how they think they're supposed to be doing it is not what the plan says, and you know, and then Kerri's test catches them for the first time.
Right. So yeah, you're talking in that first audit year that the plan has triggered the participant count and required the audit. Is that correct, John?
Yeah.
Yeah.
Yeah, they've gone over it with 100.
Yeah. Okay. So, you know, one thing that comes to mind that we see on a regular basis as the advisor is, you know, we'll notice that maybe bonuses get paid in the new calendar year, which is the new plan year, and some highly compensated employees will just take care of their full, you know, contribution limit out of that bonus, which is fantastic to do on one hand, but on the other hand, Laura, I'm looking at you.
Yeah,
You know,
that's-
sometimes they miss out on some match by doing this.
Well, there's two issues in that, Paul. First, you mentioned the match. What's the match determination period? Is it each pay period or is it the entire plan year? If it's each pay period, you want to spread your deferrals out evenly through the year so that you're withholding the match amount each pay period to get the full match. If you load it all up in one bonus pay, your match is going to be on that bonus pay only and not your annual comp. I really try to counsel, especially our highly compensated employees on that, because we want everybody to get the most out of the plan. So the match determination period, while it's simpler if it's each pay period, it does have some consequences. The other issue I would say too, Paul, especially if it's early in the year and they're loading up on their bonuses. If you're not a safe harbor plan, what does that do to your discrimination testing? Are you monitoring your highly compensated? Let's say you've identified them and you know they can defer 6 or 7 or 8% of pay, but they're loading up their bonus early on and then they terminate employment shortly thereafter. So they end up with a deferral rate of 16%, which goes into your discrimination test and hurts all the rest of the highly compensated employees. So from an employer's perspective, I would discourage, you know, sometimes you got to do what you got to do, but I would discourage letting someone load up early in the year on their bonus pay where you're subject to discrimination testing. It can come back and haunt you.
It seems like there's been more negatives that we've encountered with our clients than positives for sure with that. So Kerri, I'm going to shift gears just a little bit. We have new auditing standards for retirement plans, and we highlighted those in last quarter's webinar. Just for a refresher and for any of our new listeners, can you briefly summarize those new auditing standards for us?
Yeah. So the AICPA in July of 2019, they issued a suite of SASs 134 through 140. But SAS 136 is forming an opinion and reporting on financial statements of an employee benefit plan subject to ERISA. So that particular SAS is for employee benefit plans. It's effective for periods ending on or after December 15, 2021. So for the year that we just ended, the audits we're going to be doing this summer, this SAS is in effect. So prior to SAS 136, plan sponsors could instruct their auditors not to perform any procedures with respect to the investment information if it was certified by a qualified institution. And we would refer to those as a limited scope audit. And we would obtain those certifications and disclaim an opinion on those financial statements. But under the new SAS 136, now the limited scope audit is going to be called an ERISA Section 103A3C audit. And a full scope audit is a non-ERISA Section 103A3C audit. So the auditor will issue an ERISA Section 103A3C audit, and it will have a two-pronged opinion, one based on the audit itself, and then one on the procedures performed relating to the certified investment information. So with that, the plan sponsors have some additional responsibilities. They are going, if they're going to elect an ERISA Section 103A3C audit, which honestly, I think probably 90 to 95% of our plans are limited scope or Section 103A3C audits. They're going to have to determine whether they have a valid certification and whether the certification is from a qualified entity and certifying that the information is both accurate and complete. They're going to have to provide the auditor with a substantially complete draft 5500 before the audit can be issued. And they have to prepare, fairly present the financial statements. The auditor has to inquire about how the plan sponsor made the determination and obtained the certification. We also now have to communicate any reportable findings to those in charge with governance. We've always issued management comments or recommendations. Those letters now have to be addressed to those in charge with governance instead of maybe the controller or the CFO. So those are that's kind of a summary of the changes. Plan sponsors are going to see changes to the engagement letters, the governance and planning letters, the management representation letters, governance and conclusion letters, and of course the audit reports are going to be much lengthier than they were before. So that's kind of the summary of the changes that are coming down.
So are all those changes, Kerri, are those going to lead to a longer list of items that the auditor is going to need access to? And should employers expect an increase in the amount of audit time on site? I'm picturing this Volkswagen pulling up and, you know, instead of 2 auditors hopping out, about 7 of them popping out.
You know, I think on the planning phase, there'll be a little bit more. I mean, we are part of the Employee Benefit Plan Quality Center, and they have come out with a tool or checklist, which we are going to use and modify slightly. And we want to sit down with our clients during the planning phase and go through that checklist to help them make the determination whether they can elect an ERISA Section 103A3C audit. We're kind of wondering what the new, if the certifications will be a little bit different. You know, we need to make sure that they're addressed to the plan themselves, you know, that it says it's accurate and complete, that it is a entity that's allowed to issue an ERISA Section 103 certification, which would be a bank, a trust company or insurance company, and that it's signed by somebody that's authorized from that institution. So there's kind of a checklist that the plan sponsor needs to use. And so I think we're going to probably give those to our clients to go through and sit down with them on the planning end. The main thing is for auditors, we need to have the newest plan document and amendments and make sure that those relevant plan provisions and the risk associated with those, and that we're testing those risks. So we have to do, we've already been doing this, but some auditors, maybe they haven't been testing the relevant risk, relevant plan provisions. I think we have already been doing that. We just really need to make sure we're reading that plan document, that we've got all the relevant plan provisions, and that we're testing those. So I don't think that the list will be much lengthier, other than, like I said, doing that checklist tool with them. And then, like I said, spending more time up front with them on that end. So that's what I foresee.
Yeah. And so Laura, you know, I know TPAs can assist with some of the audit items. What are the routine regular items? What are some additional items that maybe TPAs could assist with, provide to the employer or directly to the auditor to just help them out some?
Well, Paul, we've always thought that the report we put together at year end should go to the auditor. And we do a full census, and Kerri mentioned how they need a full census. Well, if our compensation ties out to the year-to-date payroll register, and it should, and we can provide it in an Excel spreadsheet format, it might make it easier for the auditor to do their sampling. We can make that process simple. We pull financial statements for the plan. We, of course, prepare the 5,500, the draft, and to my recollection, we've never had an adjustment posted, but that's not to say it could never happen. But it gives, they of course have to have a 5,500 to review. Our report includes compliance testing. That would be ADP, ACP discrimination testing if it's not a safe harbor plan, top heavy testing, coverage testing. We review the fidelity bond. So I think our report is a good start for auditors. Now, our reports don't include the investment detail they're going to need to, the certified statements. You know, presumably the auditors will get their own access onto the record keeping platforms. I know if I'm an auditor, I want to go directly there myself. We can feed them that data, but I'd probably want to go there myself, pull down the reports they need to help them with that. And so much of the work goes back to the employer. And, you know, I know Kerri has to test payroll and get into those HR records and all of that. That's so much fun. We can't really help with that. But we can help on the financial accounting and providing a good census and compliance testing area.
Laura, I'm gonna ask a question. You know, some employers have a 180 service with their payroll and their record keeper. Some have a 360 integration service between their record keeper and their payroll. The 360 is basically both systems talking back and forth to each other. The 180 is just a one-way conversation, payroll to the record keeper. Is there any difference in the census information that you receive from from clients is one census more accurate using a 360 versus a 180? Have you know?
Well, it ought to be equally accurate, but I'll be honest, and maybe it's going back to my old CPA days in public accounting. I want to go to the original record. I'm not going to take the record keeper's records on compensation. I want to go back to an original source if the employer will let us. If they say no, go with that. We've reconciled it. We know it's good. Okay, we'll go with that. But otherwise, I would like to tie it back to the payroll records and make certain. I have seen things get missed, even with integration. And I encourage employers, especially if they're subject to an audit and they get larger, to look at integration with payroll and their record keeper. But I still like to go back to the original payroll records and tie it out.
Oh, that's what I figured, but
It's not required. Every employer can make their own decision, but if we're not tying it out, somebody needs to be. Don't leave it to your auditor to do it. Get it done before they're in there.
There you go. Exactly. Hey, John, you mentioned Form 5500 and it not getting filed. So let's talk about the Form 5500 and the audit report filing deadline. Let's say that 5500 is ready, but the audit's not complete. What should the employer do? Should the employer go ahead and file the Form 5500 without the audit? Should they wait for the audit? What do you recommend here?
It's sort of you're hurt both ways. If you file the 5500 without the audit, you're going to get a nice letter from the IRS saying, "Hey, you didn't file the audit, so your 5500 doesn't count. It's incomplete, and we're going to assess penalties." And if you file nothing, well, then you're late, and we're going to assess penalties. So a lot of times I'll say, well, how soon is your audit going to be ready? If we're talking a few days, I'm going to say, go ahead and wait. We'll file it all together late. If we say, hey, it's going to be a while. We got information to our auditors late, or we have a whole host of other issues going on that's caused the audit to be delayed, or we forgot we needed an audit and we're just now getting started. So sometimes in those cases, I'll say, go ahead and file the 5500, at least get that in the system, and then we can sort of plead for mercy on the audit if it's late. So sometimes, if it's a short window, I'd rather just do it all at once, and maybe we go for a day or two. But if it's going to be a lengthy amount of time, at least it gets something on the board, we'll say. And Kerri and Laura may have other opinions of what they advise there.
We typically suggest, like you said, if it's going to be a while, which that's usually what we see, we do ask them to go ahead and file. That way they're not getting the late filings. Although, like you said, then they could say it's incomplete. But we do tend to tell them to go ahead and file and maybe attach something to say the audit is in process. Yeah. So that's usually what we will recommend.
Yeah, I'll say, in EFAS, you put some comments in. So, go ahead and explain sort of the situation. And I mean, it's the government end of the 5500 is all computers anyway, but at least it's sort of logs that you had, you send an explanation in. Who knows, maybe the audit gets in before they catch it, which is the best case scenario. Like you get the letter and say, oh, well, we already filed that 2 weeks ago.
Has anybody noticed, or maybe you even know the reason why, and this is a jump ball for whoever wants to answer this. I've noticed that the audit report is not immediately accessible on the EBSA's website after the 5500 gets filed. Is that purposeful from the Department of Labor, or is there a reason for that, I guess, is the question.
I don't know, but I've seen that as well, that it's not ready. Like I'll see the 5500 out there, but I won't see the audit. So right. I've seen that too, but I'm not sure.
I think they're scrubbing the information to make sure that nothing confidential is attached. You know, sometimes people might mistakenly attach their 8955 SSA with social security numbers or something on it. So we have definitely noticed that there's a lag, and my understanding is that they're scrubbing the attachments to make certain there's nothing inappropriate on there.
We've,
Yeah, I
Which would
think
make
the
sense.
5500 is almost automated, and then the audit, there may be a human involved there somewhere, just to double check everything, so it slows it down.
Yeah, one thing I would want to caution plan sponsors, you know, don't attach your management recommendation letters. With, you know, sometimes you might accidentally put the audit and then all the other stuff that we sent, you know, just you don't want that out there for everybody to see. So just make sure you're just attaching the audit.
Kerri, I haven't seen that, but Laura, you bring up a good point. I've seen an employer, not a client of ours, but an employer file a report on delinquent loans, mistakenly reporting participant loans and including socials and home addresses. It was just unbelievable. So, yeah, don't do that. Definitely do not do that. So
That's up there, the HIPAA breach. You don't want any of the cybersecurity or data security police after you.
right, exactly. So Laura, excuse me, the auditor, you know, the audit is pretty much finished. They think they've found a potential issue with the compliance testing. Maybe it was the data going in, maybe they have questions about the test itself. From a TPA perspective, would you prefer if the auditor addressed these potential issues with the employer first, or came directly to you to maybe get some clarification?
You know, certainly we wouldn't object if they go to the employer first. That's their client. But there have been some cases, not often, but there have been some cases where the auditor was wrong. They did not really understand the issue. And if they'd run it by us, we could have saved them some grief. It doesn't happen often. Most of the auditors are they know what they're doing, but we would appreciate knowing if there's any lapses, just so we could be on the lookout for the client. We're not going to see everything. You know, we don't get into the payroll processing. We're not into the HR records, but if we can see there's a weakness, we'll keep a lookout for it. So I'd appreciate the professional courtesy, but it's certainly not required.
So Kerri, what happens, you know, normally for you all, if you come across something, are you addressing it with the employer? Are you going to the TPA? How?
We usually address it with the employer and then have them go to the TPA. That's typically how we do it.
Okay. So John, there's a testing failure on the compliance. It needs to be rectified. You know, what happens to correct that testing failure? What's the steps involved with that? You know, taking it a step further, let's say that it's a compliance testing failure that occurred in a previous plan year that maybe came to light in a subsequent plan year audit. How does that get best addressed?
Yeah, as I said earlier, it's always harder when you start splitting tax years. You know, one thing we do recommend, and one thing we do see, we're seeing more and more, is some TPAs might run sort of a mid-year sample testing, or if they know they had issues in the prior year, run it in the middle of the year so you can maybe get ahead of any potential issues, especially if you have highly comps, really deferring some cash in because of bonuses or anything like that. We find out in June and say, all right, we can slow it down. You know, if we catch it and it's that year, there are correction programs, you know, you can go through. A lot of times, as part of the testing, whoever ran the test will say, here's the recommendations for what you need to do to fix it. Maybe it's we need to exclude some people. Maybe it's we need to make a qualified non-elective contribution, a QNEC, to the people that did not defer as much, so those that were, we'll say, discriminated against. Possibly potentially earnings, those sorts of things that we have to help make up depending on what happened. But it sort of varies based on how we failed. You know, if it's we accidentally excluded a whole bunch of people and we failed because of that, well, now we got to get them in and make up some contributions. If it's the highly comps deferred too much and that's why we failed, well, now we're looking at doing a refund to our highly comps and making sure the taxes pay on that. And that's never a real fun you know, it's a much better conversation. It's still terrible to say, hey, we accidentally kicked you out of the plan, but here's this money to make you whole, versus, oh, sorry, Chief Executive Office Suite, you put too much money in the plan, so now we're taking money out of your retirement, giving it back to you, and now you get to pay taxes on it. Congratulations. So depending on where that failure occurred that's identified in the testing is going to really dictate how we fix it. But whether it's the current year or the past year, it's all relatively the sort of the same corrections. It's just a matter of how it's reported, and do we have to now issue, you know, go back and issue some corrected W-2s, which we really hope we don't have to. But if, you know, if we've missed the tax year, you know, now we're, you know, now new W-2s potentially, and now people are having to redo their taxes. So it can be pretty messy, you know, if we've missed, you know, if we catch it in later years.
Right.
And John, just that's what we typically see is excess contributions that have to be returned. I mean, that's probably the number one thing that we see on compliance testing.
Yeah, and that's why I always say, you know, if it's ever possible, run that mid-year test or learn from the test you ran the prior year. You know, if you failed a couple years in a row, well, maybe now it's not time to put limits in on our highly comps to say you can only defer up to say 80% of your limit, so we can pass that test. Or we start investigating a safe harbor plan.
Mm-hmm.
So potentially that may increase your costs a little bit from the safe harbor matches, but in the long run, it may save time, money, energy, and sort of employee relations, you know, by doing that, where you don't have to keep going back year after year and say, sorry, you deferred too much again.
And I'll just add, you know, we've come across plan sponsors that don't necessarily want to commit to the safe harbor contribution, maybe because it's 100% vested, maybe some other reasons. Just adding an auto enrollment feature and even an auto escalation. So the auto enrollment where individuals will automatically have a certain percent, say 5, 6, 7% deducted from their pay from the beginning, and then auto escalation where on an annual basis, that deferral rate gets adjusted, increased by 1% per year. That can help ultimately with the testing results as well.
Yeah, and Paul, I'm not, your experience probably some remind, but most companies that have the auto enrollment and auto deferral, even with or without an escalator, most employees just, once they get used to their paycheck, if their first paycheck has it withheld, they never really notice, and
Right.
They just keep going. And especially in, you know, manufacturing or anywhere you have a fairly wide disparity between sort of your rank and file and your highly comps, even that extra 3% from a bunch of new people is really going to help improve the results of that testing.
It's going to help improve the results of the testing. And then frankly, when we go out to do employee education, you know, it's rare that we come across an employee, a participant who refuses to acknowledge that they need to save for retirement. I mean, everyone knows they should be saving for retirement, and just helping facilitate that process through auto enrollment. You know, we find in conversations with employees, they actually prefer that. So it's kind of interesting.
Yeah, I think, you know, it's inertia. If it just is part of onboarding, you're auto enrolled, they're not going to take the time to, you know, hit the opt-out form, or you've already taken care of it for them. So, you know, I would have enrolled, but I had to fill all these forms and maybe I wouldn't have, but now it's done. And I don't have to worry about it anymore.
Right. So Kerri, I'm going to ask this on the audit side. You know, you've referenced a management letter listing the findings a couple of times. You know, you have that letter, you review it with the employer. You know, does the employer always agree with you 100%, or is there any pushback?
You know, normally they do. We don't get a lot of pushback. No, I wouldn't say. And every year we go through with the plan sponsor. Okay, here's the findings that we had. What did you do to correct them? What have you done? And then we document what they have done to make those corrections. And we're hoping that they don't do them again. You know, sometimes they're already too far into the next year once we issue them. So, you know, it may happen for a couple of years just because of when the audit takes place. But, you know, I think most plan sponsors want to do right by their employees and correct the plan and make sure it's in compliance. But, you know, if, you know, we could issue a modified opinion on the auditor's report. We haven't, I don't think we've done that. But most of the time, you know, the plan sponsors do want to make corrections and make the participants whole and get their plan in compliance.
And Laura, you know, from that perspective, from the TPA's perspective, do you appreciate the employer sharing the audit management letter findings with you?
If it relates to anything we can assist them with, sure. And we when our clients have an audit, we view that as you know, get the most out of your audit. If something's not working, they're going to find it and listen to them. And, you know, we try and help our clients when they start hitting the 80 participant threshold, start getting ready, because they don't always listen to us the same way they listen to their auditors. When we go, this is really important, they go, okay, Laura, but man, the auditors write it up in a management letter. It's a little more persuasive, I think might be the word. So we view them as, you know, someone we like to work with, that we're on the same team. And I think most employers want to do it right. I've never had a situation that I'm aware of where an employer and the auditor didn't ultimately agree. I mean, they always worked it out and tried to follow the recommendations.
Fantastic.
Yeah.
Go ahead,
You may
John.
hear some grumbling, but they always sort of work it out. I usually get the phone call. They get the management letter from Kerri, and then I get the phone call and said, "Hey, they found all those problems with our plan." I'm like, "Well, let's go through them first before we start saying we have massive problems with the plan, because you know they're all very important, but some of them can be fixed a lot easier than others."
Right.
And so, you know, as Laura said, you know, everybody's sort of on the same team here with the plan. You know, we're all trying to keep you in compliance and make sure no one gets in trouble and you have a great plan for your employees. And so it's, you know, it is important to share that with sort of all your service providers, because everybody has a part to play in making sure it doesn't happen again or it gets fixed, you know, for that plan year.
So, you know, we're coming to the end and it's time to summarize. Takeaway I heard from all this is it's best to, you know, prepare the census information and answer all the questions that Laura and other TPAs ask, answer them accurately and completely, and get things in order, kind of take the vitamins, so to speak, the preventive medicine. So Laura, do you have any additional thoughts?
No, and I would just say, the very best employer can make a mistake. And as John mentioned earlier, there are a lot of programs into self-correct. Don't beat yourself up because something happened, just fix it. It can happen to the best of us, that you can make a mistake.
Kerri, anything to add there?
Just make sure you have the most up-to-date plan document and amendments, and make sure that you're following the plan provisions. Go through them maybe once a year and just make sure that you are following what the plan document says.
Perfect. And John?
No, I would 100% echo that. Most of the time, the mistakes that I get involved with is because the plan document said one thing and you thought it said that, but it actually, you weren't quite doing what it said. So if you ever have questions, you know, call your TPA, call your lawyer and say, "Hey, here's what we're doing." Because sometimes we can amend your plan document to reflect what you're actually doing, so then we don't have that problem anymore. You say, "We want to do it this way." Well, there is flexibility in those plan documents to make changes to do it how you want to do it. within reason.
Perfect. So, well, that's it. I'd like to thank Laura, our special guest, Kerri, John. Thank you for your time. Hopefully our audience has found this extremely informative. I'm not sure if Katie's jumping back on, but just in case she's not, I will say, if you've stayed on for the whole time, you will be receiving a certificate that will include the continuing education. And we hope that you find this invaluable, and we will be back in a webinar in the second quarter of the year. So
thank you so much, Paul. I am here. A huge thank you to you for moderating. You did a fantastic job. And to Kerri, Laura, and John, phenomenal information as well. Very much appreciate it, and appreciate the ongoing partnership with HORAN and Graydon. As Paul mentioned, we will be sending out CPE certificates to anybody that basically is still on the call. If you don't get one and feel that you should, please shoot me an email and let me know. And we will be sending out a link to the recording later on today or tomorrow, as well as the contact information for all of our panelists. Thanks again, and enjoy the rest of your day.
Thank you.
Thanks,